The United States has a really big budget deficit, meaning our bills are higher than our income. In order to fund these huge deficits, the United States Treasury borrows on global bond markets. Our debts are now north of $30 trillion, and the Treasury expects to borrow $10 billion every day between now and December. So that number is going to go up, up, up. We trade bonds like stocks, and they're used for capital intensive projects like energy infrastructure and building hospitals. About 40% of the money is owed to foreign investors. That means that we're reliant on the willingness of foreign investors to keep buying and holding US bonds instead of demanding repayment plus interest. Back in the earlier 2000s, around the time of the financial crisis, that number was closer to 50%, but it was held mostly by central banks, like the governments of China and Japan. However, the 2008 financial crisis prompted many of these governments to further diversify their holdings. The stronger foreign government's currency is against the dollar, the less treasury bonds they buy. Now there are foreign private holdings, like accounts in the Cayman Islands, that own more than foreign official institutions. The dollar has been weakening a while, so fewer central banks have been buying fewer bonds for quite a while. They'll also buy fewer bonds when they don't feel like the United States is stable or when we make countries mad for no damn reason. The shift from more official holders to more private accounts is interesting because we don't really know how private buyers behave in a crisis. Something unexpected could trigger a lot of over-leveraged private investors to sell off bonds, similar to what we saw in March 2020. There's also quite a bit of pre-pandemic debt maturing in the next couple years that will need to be refinanced. We like when foreign governments buy bonds because it spreads more of the risk around internationally. But too many private investors makes the treasury yields, or the interest rates the government pays back on the debt, less predictable and more volatile during periods of economic stress. Private investors are also more interested in making a profit than keeping an empire afloat. And at this point, the supply of our debt has outpaced the demand. We now have more debt than investors are willing to buy, and our nation's credit score has declined, meaning investors can demand higher interest rates. This has been a gradual rebalancing instead of just a bunch of investors jumping ship at once. Our country used to be seen as constantly growing and a safe investment, but that's changed over the last 2 decades. The big crash we had in '07 showed the world that we're inept policymakers, and they reacted accordingly. There are 3 ways that bond yields can decrease: government policy to address what's pushing the yields up to begin with, buying bonds to reduce supply, or declining inflation. Last week, the Treasury Secretary Scott Bessent announced that the government would buy its own bonds in an effort to raise bond prices and lower the yield. That didn't work. And yield prices fell, but only for a short period of time. And by Friday, they were back to where they were before the announcement was made, which means that bonds were trading at their highest level in 20 years. Interest payments are going to account to about 13.5% of all federal spending, which is even more than defense. It's at 5.2% back in 2021, and we're paying about $3 billion just in interest every day. Most banks use treasury yields to set the rates for mortgages and other long-term loans. So this has affected the housing market as well. Obviously, this is a bad look for Trump, who has no good looks, and is blaming the Federal Reserve for not splashing rates. He's mad at Switzerland for having lower interest rates than us and threatening to cut off trade with them because of that, and has brought up using the military to intervene in the bond market. No word yet on how we can use physical force to alter the more digital and intangible financial system, but when there's news on that, I'll let you know. Bessent may be planning on using the Treasury's general account, which currently contains about $950 billion, to double the size of its bond buybacks from $2 billion to $4 billion. He also talked about selling short-term bonds in order to buy back long-term bonds, which is a statement that has caused a lot of skepticism about the plan's efficacy. The Treasury is supposed to be regular and predictable, but making surprise, vague announcements isn't helping stabilize the bond market. The regularly scheduled bond sale is September 9th, so we'll get a clearer idea of how the market has been affected then. Later this week, U.S. economic officials are meeting at Jackson Hole, Wyoming, which is a place known for being a fiscally responsible meeting destination. The PCE, or Personal Consumption Expenditures Report for July, comes out on Wednesday, which is what the Federal Reserve likes to use to measure inflation. That could also change the market. This week will probably be very volatile for the economy. The best bet to reduce bond yields is to end the conflict in the Strait of Hormuz. The price of fuel has been the biggest driver of inflation, and the price of fuel exploded because of the conflict. It seems unlikely to happen anytime soon, so follow my page and I'll tell you how this directly affects you.